Gold and debts and deficits. The 800-pound gorilla in the room. A topic that doesn't seem to get the attention it deserves is the impact of the federal debt on the price of gold. This is Coins Roc. Stay tuned as I explain. After a brief sell-off, the price of gold is back on track, again moving towards the $2,500 an ounce level. It continues to be a good year to be a gold investor. One factor that doesn't seem to be mentioned is what the federal debt and deficits mean for the price of gold. With a current debt of $35 trillion and growing by $1 trillion every 3 months, no one in a position to do anything seems at all inclined to want to address this issue. The government continues to spend money it doesn't have. This is expected to only get worse in the next few months leading up to the election, as the current administration hopes to sway voters with new spending projects. By 2025, the cost of servicing the national debt will exceed the entire military budget. Also, the Congressional Budget Office reports that the ratio of the national debt to gross domestic product, or GDP, is now 122%, a level last seen during World War II and is not sustainable. After months of expecting the Federal Reserve to start cutting interest rates, it looks like it will finally start cutting in September. Lower rates will weaken the dollar, which in turn boosts the price of gold. The expectations are for 3 or 4 more rate cuts in the coming 12 months, which should continue to push the price of the dollar lower and the price of gold higher. Another area of concern is the presidential election. Current polls show a virtual dead heat between Trump and Harris. All this adds uncertainty, and gold tends to do well in the face of uncertainty. Bank of America, which owns Merrill Lynch, recently put out a report suggesting that gold could reach $3,000 an ounce in the next 12 to 18 months. The investment banking firm of Goldman Sachs is predicting gold at year-end prices of $2,700. While no one has a perfect crystal ball, both of these are examples of traditional investment banking firms taking an interest in gold as an asset class. Another positive for gold is the increasing geopolitical tensions in the Middle East, with the threat of a wider conflict growing. Adding to this, the ongoing war in Ukraine, plus the tensions between China and Taiwan, all adds to gold's appeal as a safe haven. The demand for gold continues to grow. While the Chinese central bank temporarily paused gold purchases, they are back at it. Other central banks around the world continue with their purchases. In their mid-year outlook, the World Gold Council estimates that central bank demand alone contributed 10% to gold's performance in 2023 and potentially another 5% so far this year. Demand is also strong from individual investors, especially in China, India, Europe, and the US. While demand for gold is increasing, the production from worldwide mines is continuing to slowly decrease. The recent sell-offs in the stock market have investors looking for alternative places for their money. While stocks have been down recently, for the most part they're still up from the past, and investors still have gains to lock in. On August 2nd, for example, while the stock market averages were down slightly, one bright spot was gold, which was up on the day. There continue to be many factors pushing the price of gold higher. The federal debt is only one of many. Remember that this is only my opinion, not investment advice, but I believe the future for gold looks bright. This has been Coins Roc. Thanks for watching.